consideration when you're switching your primary residence into an investment property. In terms of expenses, many people don't necessarily know which expenses are tax deductible and in what way. So some expenses that you do, like lump sum, what's called capital work, so whether you're putting in a driveway, an extension, those are not expenses that you would typically claim as your tax in the year that you incurred them. Typically they go on a depreciation schedule or just get added to your cost base of a property. Again, there's so much more nuance to that. We're trying to keep this at a pretty high level. Whereas having a plumber or an electrician come in to make some changes, those things are typically tax deductible in the year that the cost is incurred. So just keeping that in mind with your cash flow as well, there is the tax consideration. Next thing on the list would be structuring. So what I mean by that is assuming that you've been proactive, knowing that this is going to be an investment property one day, deciding based on your personal goals and objectives if the property should be in your name, maybe it's in your partner's name, maybe it's in joint names. The consideration there is that any income that comes through, it goes in proportion to that ownership. Assuming that I own 100% of a home and my wife doesn't, 100% of that income is assessable at my tax rate. The same is included with my deductions. So if I'm going to claim expenses or loan interest against my tax, I'm claiming against my marginal tax rate. So sometimes the consideration is, well, if I put it in my partner's name, will I make more in income than it'll cost me in tax? So that can be consideration there as well. Same thing with actual loan structuring. Whether you've gone principal and interest versus interest only, it depends on what goals you're trying to achieve out of the property.